Hey, what is everybody? Shaun here. One of my favorite asset classes to invest in is real estate, and I own quite a few different rental properties and multifamily units in my portfolio. However, just because you invest in real estate doesn't mean it's a good investment. You see, you have to really understand the numbers when looking at investing in a rental property, and so what I want to do in this video is actually walk you through step by step of how I go about assessing whether I'm interested in potentially looking further into a rental property. And I figured what better way of doing this than actually going online and actually finding a property and actually going through an assessment. So I had to be talking to a person earlier today who was asking about the area of Chattanooga, Tennessee, but this is a 4-unit property that is not currently on the market, but it did recently sell May 31st, 2022 for $300,000. Let's go ahead and assume that this property was on the market, and let's assess whether this would be a potential property to look or further inquire about. The first thing we need to understand is the down payment requirement to see even if this is a property that we can afford. Typically, when you're buying an investment property, you're gonna need to have somewhere between 20% to 30% down payment. Now, if this was your personal property, there are options like FHA loans where you can have as little as 3.5%. But in this case, because we need a minimum of 20%, which is usually the average, we're gonna need about $60,000 down payment. So once I know the down payment requirement and I know I can meet that, the next thing I start looking at is how much total rent is happening in this particular multi-unit or single family home. So if we go to the homeowner details right here, it actually breaks this down for us. So this is a quadplex, meaning there's 4 units. 3 of the units are 1 bedrooms, and the 4th unit is a 3 bedroom. And it says that all units are currently occupied. It does mention that the 3-bedroom unit is renting for $1,125. We have one of the 1-bedroom units renting for $749. The second unit is being rented for $700 a month. The third 1-bedroom unit is rented for $725, and that current market rent's around $800. So even though it looks like we can increase the rents, always calculate based on what's happening right now. So now that we know the total amount of rent that's being collected, the next thing I like to figure out is what is the overall mortgage payment. We go to the overall mortgage payment calculator. Remember, we said that this was a $300,000 property, and because it is an investment property, we had to put 20% down, which is $60,000. So if we take $300,000 and subtract $60,000, we're left with a $240,000 loan. $240,000 over a 30-year period at about 6% interest rate, which is around the current rate right now. We're looking at a total monthly payment of $1,439. Now keep in mind, this is the mortgage payment. This does not include things like property taxes, insurance, and stuff like that. So that'll be the next thing that we begin to calculate. So after we know the down payment requirements, we know the total rents collected, and we have the idea of the mortgage, now it's time to begin calculating the overall cash flow. So the first thing I do is I actually deduct the mortgage from the overall rents. There's a lot of other expenses. So let's break down how to get a rough estimation of the remainder of the expenses. One of the overall expenses is your property tax. So if we go into the home details again and we typically scroll down, we will find a property tax assessment of about $817 per year. Just to make the numbers easy, I went ahead and said, okay, $100 per month in property tax that we need to deduct. Now the next thing we need to deduct is property insurance. And while this particular thing doesn't actually tell you how much property insurance is, you could either call some local property insurance companies, give them the address and figure out what that might be, or you can kind of do a rough estimation. I'm estimating roughly $150 a month in property insurance. Now, the next thing we need to calculate is what's called a vacancy rate. And a vacancy rate is the percentage of time that a particular unit is not being rented. When you have a tenant move out, very rarely does the next tenant move in the exact same day. You're gonna have at least a week or two in bringing the property back to life in terms of maybe cleaning, making sure everything's disinfected. You might need to do some repainting, touch-ups to the property, a little bit of damage that may have happened with the property. Now, a lot of people have different types of calculations for this and what percentage they use. I like to be very conservative, and so I always use a 10% vacancy rate. So what that means is I take the overall collected income from the entire property, that $3,301, and I subtract 10% of that. So in our case, $330. Now, in addition to the overall vacancy rate, we also need to look at what's called capital expenditure. And your capital expenditure is the amount of money that you need to put towards the property to continue to increase the value of it and keep it in pristine condition. Now, how much you spend on this really depends on a lot of different variables, primarily on how new the property is. Typically, if you're gonna have a brand new property that you're looking at buying, the capital expenditure is gonna be pretty low, and the older the property gets, the more you're gonna have in capital expenditure. Now, as a general rule of thumb, I like to use 10% as well for capital expenditure, just to give me a rough ballpark. So in our case, this is gonna be $330. The next expense I look at when assessing cash flow is going to be the overall maintenance of the property. So while maintenance seems very similar to capital expenditure, it is a little bit different. So when it comes to maintenance on a property, maintenance is gonna be those times times when your tenant calls you saying, hey, my toilet's clogged, or my sink isn't draining, or maybe something happened with the refrigerator or dishwasher. But essentially your maintenance costs are just those simple things that you had to hire plumbers for, electricians for, little fix-ups. Once again, the amount really varies, but for a property like this, I would be saying at least a minimum of 10%, so an additional $330 a month. So if we take our original $1,862 and we begin subtracting every one of these expenses, we are left with $622 per month in profit. Once again, keep in mind, there are some variables to this stuff, so it's never an exact science. There's one other expense I'm not putting in here, which could be property management. And this could be really important for those of you who do not want to manage your own property and want to have a professional do it. Or if you're like me and own property out of state, you may need to budget for this as well. Now, I didn't put property management in this calculation because I'm going to assume that we're going to be managing the property ourselves. Property management companies also range in expenses, but I've seen them anywhere as low as 4 or 5%, all the way up to 10% plus. But I would say as a industry average, you're looking at a 10% cost for this as well. So the next thing, once I calculate how much I'm going to be profiting per month, I want to figure out what my overall return on investment is. Because it's one thing to make $622 a month when you only put in maybe $1,000 for the investment, but it's another thing if you put in $1 million to only make $622 a month. So let's talk about how to calculate your return on investment. What you're going to do is you're going to take your $622 per month and you're going to multiply it by 12 months to get your yearly profit. In our case, we're looking at $7,464. I then take that $7,464 and divide by our original down payment of $60,000. Then I multiply by 100 and I end up with 12.44%, meaning that I'm getting a little over a 12% return on investment. So the question becomes, is that considered a good return on investment or not? It really depends on a lot of factors. Some of it being just how good of a deal that you purchase something for. Other is how strong of a market that you're investing in. So even though there's not like one specific benchmark, here's some general guidelines. Anything from 0% to 4% is pretty low in my opinion. Any return on investment from 5 to 7% is pretty standard or average. A return on investment of 7 to 10% is a really good deal and you're doing probably better than average. And then anything over 10% is a fantastic deal and definitely worth exploring more. Now keep in mind, there are a lot of other variables you need to think about just other than your return on investment. You want to make sure that your property is in a pretty good overall market because you could invest in a place that gives you a really high return on investment, but it's also a really bad market. It's going to be hard to find tenants. So even though theoretically you get a really high return, you're not actually realistically going to get that return. You also want to consider the fact that is this a property that could potentially resell? Is there any major repairs that need to be done? Even though we put down $60,000 of down payment, if you have foundation issues, major roof repairs, or any other major expenditures, this could really eat into your profit margins and really lower your overall return on investment. Now, as I'm looking through this general property, as you can tell, overall, it doesn't look too bad exteriorly. The roof obviously has some wear and tear on it. This chimney is a little worn down. There's nothing major so far. Looking through the inside, it actually looks, fairly well maintained. The floors look pretty decent. I'm not seeing any major cracks from some of these photos right here. This is a pretty reasonably kept up rental property. Clearly there might be some touch-up paint, maybe a few little cracks to repair. Be checking out the windows. There could be some updates on hardware on the kitchen cabinets, things like that. But overall, this property looks like it doesn't need an extensive amount of work. I would, as always, recommend before you buy any property, definitely get a whole house inspection done because there's things that you just can't see. Maybe there's structural issues that we're not seeing in these photos. There could be termite damage that we're not seeing. So you want to make sure that you're getting on an inspection to see if there's any major repairs. But generally, if as long as your foundation is good, your roof is good, also you don't have any major issues with lots of window repair, most fixes overall are going to be pretty basic and not that costly. So based on what I'm seeing right now, this actually is a pretty solid investment. I would definitely look further into it. But anyways, that is how I look at a general breakdown of a rental property and assess whether or not I want to inquire about this and maybe even look at doing a walkthrough and even see if I want to get an inspection done because I'm a serious buyer. If this video gave you some value, please be sure to smash the like button, hit the subscribe button, also hit that little notification bell for more videos like this on real estate investing, stock investing, building wealth, creating financial freedom, and living life on your terms. Let's get out there and let's build that dream.